Welcome to the Finance Abridged Digest for the week ending April 10th, 2026. Here are the top ideas you should know about from this week's review. First, you really need to shield your portfolio from a potential resumption fail in the Strait of Hormuz by monitoring physical shipping capacity.
Right.
Second, it's time to audit your retirement accounts for the silent partner risk, which is being driven by our nation's 125% debt-to-GDP ratio.
Yeah, that's a big one.
Third, you should be watching the $100 billion a month wartime stimulus. This is a mechanical driver that could actually push the S&P 500 to 7,700.
Which is wild.
I know, right? And finally, you need to reprice your tech expectations around a new 1000x compute shock, and it's being driven by autonomous AI agents, not just chatbots.
Exactly.
So we have a lot of underlying plumbing to get into today, but there are two things you absolutely need to stick around for.
Yeah, definitely.
There's a startling 31 basis point anomaly in the bond market right now that perfectly mirrors the summer of 2008. We'll get to exactly why the bond market is currently overriding the Federal Reserve and signaling a rate hike.
It's crazy.
Yeah. And we'll also look at why a staggering percentage of traffic on a major blockchain isn't coming from humans at all, but from autonomous economic agents trading with each other.
Yeah, you won't want to miss that.
Quick reminder, nothing in this show is financial advice. We don't know your situation, your goals, or your risk tolerance. We're here to break down what the experts are saying so you can make your uninformed decisions.
Right, exactly.
Okay, so I was looking at my portfolio this morning, and honestly, it feels like I am being gaslit.
Yeah.
I mean, there's a major regional war happening. Crude oil is surging toward $100 a barrel. Consumer sentiment is totally in the gutter. And yet, my stock ticker is just happily blinking green, like absolutely nothing is wrong.
It's surreal.
It is. We're sitting incredibly comfortably at 6,816 on the S&P 500. That's just 3% off all-time highs. It's a complete paradox, like the ultimate green screen.
I get it. The disconnect between the headlines and your brokerage account is just staggering right now. But the market isn't actually ignoring reality.
Okay, then what is it doing?
Well, it is responding to a very specific flow of liquidity that completely overpowers all that geopolitical fear. We are seeing structural forces at work that dictate exactly where capital has to go, regardless of how grim the news looks.
Okay, I hear that liquidity flow argument constantly, but let me push back on that a bit.
Sure.
How does the government buying missiles or funding defense initiatives actually prop up my shares of a tech stock in the S&P 500? What is the actual path of that money?
Right.
Because Tom Lee is out here targeting 7,700 for the S&P, which is what, another 12.9% gain?
Yeah, it's a huge target. Let's trace that money exactly like Tom Lee at Fundstrat does in his wartime stimulus framework.
Okay, lay it out for me.
So when the government pushes out roughly $100 billion a month in supplemental spending for defense and regional support, that cash doesn't just disappear.
Right.
It goes to defense contractors, who then buy software, who upgrade data centers, who hire logistics firms. It flows straight into corporate top lines.
Oh, I see.
Now, contrast that with the pain the average household is feeling from high oil prices. Lee calculates that this energy tax...
Or the energy tax.
Yeah, the extra cost extracted from consumers at the pump. He says that's only about $4 billion to $5 billion a month.
Wow, wait, really? So the liquidity injection is like 20 times larger than the extraction?
Exactly. That 20-to-1 ratio is a mathematical certainty that basically forces asset prices up. Because of this massive liquidity floor under corporate earnings, Lee argues the market is essentially spring-loaded right now.
But I mean, that completely ignores the reality of the everyday household.
It does.
Danielle Park pushes back incredibly hard on this narrative in the research. She looks at the very foundation of the consumer economy, and she says it's rotting from the inside out.
Yeah, Park's data on the consumer foundation is really sobering. She points straight to the University of Michigan preliminary April sentiment index,
Which just plunged, right?
plunged to 47.6. And that number is critical because it matches the record lows we saw during the 2008 financial crisis. Every single component of that index declined.
That's terrifying.
Her argument is that you simply cannot sustain a multi-year bull market on government defense spending if the household foundation is crumbling under, unaffordable housing and maxed out credit cards.
Yeah, makes sense.
She looks at afternoon market sell-offs on high-frequency trading tapes as signs of organic weakness underneath the surface. And she actually uses the exact same word you did. She calls the rally gaslighting.
Wow. And beyond the consumer hollowing out, the geopolitical tension itself has real-world risks that could completely shatter that corporate liquidity loop.
Oh, absolutely.
Because Ryan Bohl points out that everyone on financial TV is cheering a diplomatic ceasefire, but under the surface, there's a serious breakdown.
Right. Bohl maps out what he calls the Islamabad negotiation gap. Diplomacy has quietly stalled, and based on his tracking, he calculates a 70% probability that the Strait of Hormuz will reclose by April 25th.
A 70% probability. That's massive.
Yeah, and if that happens, the global economy hits what he calls a refinery cliff. East Asian physical inventories of crude are already at critical lows.
So it wouldn't even matter how much money is flowing.
Exactly. You can pump all the paper money you want into defense contractors, but a lack of physical crude transit forces global energy rationing. That physical shortage would instantly override any tech-driven market gains.
But then you have someone like Andrei Steno who looks at that exact same Middle East situation and says, nope, I'm buying risk assets.
Yeah, he's totally unfazed.
Steno argues that a lot of this doom narrative, specifically the rumors of sulfur shortages floating around AI-generated substacks, is what he calls 100% bullshit.
That's classic Steno.
Right. He thinks it's deliberate algorithmic manipulation designed to scare retail out of their positions. So as an investor managing my own portfolio, What is the actual gauge I can watch to see who is right?
It's pretty straightforward. Keep your eyes on the U.S. defense supplemental allocations versus that University of Michigan sentiment index.
Okay.
If supplemental spending stays above $80 billion a month, but consumer sentiment stays pinned below 50, you have confirmation of a bifurcated economy.
So the split screen economy.
Exactly. It means the market is surviving purely on government liquidity while completely ignoring the household reality.
Okay, let me stop you there, though. If the consumer is truly matching 2008 crisis levels, how in the world did we just print a headline jobs surprise of 178,000 new jobs?
Yeah.
Is the Bureau of Labor Statistics just pulling numbers out of a hat? Like, how can the Fed be celebrating a strong labor market if the foundation is crumbling?
Well, Danielle DiMartino Booth addresses this directly. She points out that the Federal Reserve is suffering from profound data blindness.
Data blindness.
Yes. The data isn't entirely made up, but it is heavily distorted by underlying statistical models. She highlights two specific culprits driving that 178,000 number.
Okay, what's the first one?
First are strike returns. That's workers coming back to payrolls after a union labor dispute. It registers on the spreadsheet as organic job growth, but it's really just the same people returning to work.
Okay, that's misleading. And the second?
Second is the birth-death model.
I've seen that term a lot this week. What exactly is the birth-death model? Because honestly, it sounds incredibly morbid for an economics report.
It does, but it refers to the birth and death of businesses, not people.
Oh, thank goodness.
Right. The government can't possibly survey every single new small business that opens or closes its doors each month. So they use a statistical guess-the-birth-death model to estimate how many theoretical jobs were created by new businesses that aren't in their system yet.
Wait, theoretical jobs?
Yeah. This month, that model simply assumed the creation of 179,000 unverified jobs.
You have got to be kidding me. So the entire jobs beat was basically just an assumption in a model.
Pretty much. So the Fed is making massive interest rate decisions based on ghost numbers.
That is insane. And if you think the stock market is ignoring reality, wait until you hear what the 2-year Treasury yield is screaming about the Fed's next move.
It's loud right now.
Because while the Fed is flying blind with ghost numbers, the bond market seems to know exactly what is going on. George Gammon highlights a terrifying 2008 parallel. Right now, the 2-year Treasury yield has surged to 3.96%.
Yep.
But the Fed funds rate is sitting at 3.65%.
Right. And in a healthy economic cycle, the Federal Reserve sets the tone and the market follows. But in a crisis, the market leads the Fed.
So they're taking control.
Exactly. That 31 basis point spread is no accident. The bond market is a massive real-time pricing engine, and it is actively overriding the Fed's pause narrative. It is pricing in a rate hike, not a cut. Gammon notes the probability of a hike jumped from 0% to 7% in a single day. The collective intelligence of the bond market is basically screaming that inflation pressures are vastly worse than the Fed admits.
Okay, so as a retail investor, if we are facing high yield, high risk plumbing, and a potential credit contraction, how do you physically protect your cash?
Yeah, that's the big question.
Because if the bank is under pressure, is my money even safe?
Rick Rule provides a brilliant framework for cash management here. We have to distinguish between counterparty risks, specifically understand the difference between bank cash and T-bills.
Okay, break that down.
Bank cash, that's the money sitting in your everyday checking account, is actually an unsecured liability of a commercial bank.
So it's basically an IOU from the bank.
Exactly. If a credit contagion event happens, your access to that money depends entirely on the bank's solvency.
Whereas a T-bill is a direct liability of the U.S. government.
Correct. Rule argues that building a T-bill ladder, buying short-term government debt that matures at different intervals, is your primary protective strategy right now.
Because the government can print money.
Exactly. The U.S. government can always print units of currency to satisfy its debt. A commercial bank cannot do that. It is the safest way to maintain dry powder without taking on commercial banking risk.
Okay, but if I'm moving my cash into T-bills to chase those 3.96% yields, I can't be the only one doing this.
You're definitely not.
If the whole world is trying to buy U.S. debt at the same time, what does that do to global currency? Everyone keeps reading these headlines about BRICS nations and de-dollarization, thinking the U.S. dollar is losing its dominance.
Right.
But it feels like a bathtub. Everyone thinks the U.S. dollar drain is unplugged, but the water is actually rushing incredibly fast toward the U.S. side of the tub.
That brings us to a really fascinating macro tension between Mark Faber and Brent Johnson. Faber looks at the U.S. and sees the end of an empire cycle.
Meaning what, exactly?
He points to our unpayable debt and overvalued equities and argues that capital must naturally rotate toward Asian markets, which are the new centers of physical global trade.
But Brent Johnson counters that with his dollar milkshake theory.
Right.
The best way I can understand Johnson's view is to picture a margin call on the entire world.
That is the perfect analogy. Johnson acknowledges that the U.S. dollar's share of global central bank reserves has hit a 31-year low.
Okay.
But here's the underlying reality. Over the last decade, foreign governments and corporations borrowed tens of trillions of dollars denominated in USD.
Oh, wow. So they owe dollars.
Exactly. When a crisis hits or U.S. yields spike, that creates a massive debt siphon. Borrowers all over the world are suddenly hit with this global margin call. They must acquire U.S. dollars to pay their interest and principal.
They have no choice.
Right. So international capital is aggressively siphoned back to the U.S. This could completely crush the Asian equities rotation that Faber is predicting.
To make this currency war even more complicated, Andy Schectman points out what's happening with physical assets in response to this paper margin call.
Yes.
He tracks the ComEx physical drain. Silver is sitting at $75.68 right now. And Schectman notes that sovereign actors are permanently removing physical registered inventory from the vaults.
That's a crucial detail.
Wait, before we go further, when he says registered inventory, he means the silver that is actually available to be loaded onto a truck and delivered right now, not just theoretical paper claims, right?
Spot on. The ComEx is the primary exchange for trading metals, and registered means the metal meets all standards and is sitting in the vault fully ready for immediate delivery.
So they're taking it home.
Yeah, sovereign wealth funds and central banks aren't just trading paper contracts anymore. They are demanding physical delivery and taking the metal home. It is a total flight from paper liabilities.
Wow.
To monitor this tug of war, watch the correlation between the DXY, that's the dollar index, and gold, which is currently at $4,751.68.
Normally those move in opposite directions, right?
Right. But if both rise simultaneously, it confirms Johnson's milkshake thesis. It shows extreme stress on global liquidity. Dollars are desperately demanded to service debt, while gold is simultaneously demanded for systemic safety outside the traditional banking system.
Okay, so if all this global capital is being siphoned back into the U.S. to service debt and chase yields, where is it actually going once it gets here?
That's the million-dollar question.
Well, the obvious answer in the sources is tech infrastructure. But I need to understand why right now. We've been talking about AI for years. What actually changed in the last 6 months to cause a 1,000x demand shock in energy and compute power?
Jordy Visser breaks down the exact mechanism of this shift. We have crossed the threshold from the chatbot era into the agentic era.
The agentic era. Okay, what's the difference?
A chatbot requires a human to prompt it. You ask a question, it answers, and the compute power stops. An agent is an autonomous workflow. It runs continuous background loops, testing, failing, researching, and reprompting itself thousands of times a second to solve a complex problem.
Oh, man.
Visser notes that this continuous feedback loop is the sole reason for the 1,000x demand shock eating the power grid. Compute is no longer being priced as a simple software feature. It is being rapidly repriced as a scarce commodity and critical national infrastructure.
And Raoul Pal backs this up with an absolutely jaw-dropping metric. He looks at on-chain data and points out that 30% of all traffic on the base chain is now autonomous AI agent-to-agent transactions.
Not humans.
Not humans at all.
Yeah.
We have software agents actively trading, negotiating, and optimizing with each other.
Which introduces a massive structural threat to the labor market. If AI agents are autonomously handling tasks at scale, we are witnessing the destruction of the corporate ladder.
Right, because if you automate all the entry-level tasks, the research, the data entry, the basic coding, how does a human being ever get their foot in the door to eventually become a senior manager?
They might not. Visser and others warn that this cause and effect could push long-term labor force participation down toward 30% or 25%.
That is unbelievably low.
It is. This makes it absolutely critical for you to own productive technology assets in your portfolio. If wage growth stalls because entry-level roles vanish, your assets need to do the earning for you.
For the listener managing their own portfolio, the watchable indicator here is data center energy consumption compared to AI agent on-chain labels.
Yeah, that's the metric.
If autonomous transactions cross 50% of network traffic, this agentic economy is officially self-sustaining. So let's bring this all home to the actual portfolio architecture.
Let's do it.
We've got geopolitical cliffs, a Fed running on ghost data, a global margin call, and AI agents taking entry-level jobs. How do we synthesize all of this into defensive architecture for our accounts?
We need a plan.
I think about traditional tax-deferred 401ks right now, like a silent partner.
Ooh, I like that analogy.
Having all your money there is like building a wildly successful business, but signing a contract that lets a silent partner retroactively decide how much of your profit they get to take when you finally retire.
And that silent partner is the U.S. government. Brandy Mabin lays out the brutal math behind this. Our national debt to GDP is at 125%.
Right.
The state has a mathematical incentive to inflate away that debt to survive, and inflating the debt mathematically guarantees higher future tax rates to cover the interest.
You have to get the money somehow.
Exactly. If your money is locked in a traditional 401k, the government has a variable, expanding claim on your wealth. Mabin's actionable framework is the rule of thirds.
Okay, what is that?
She suggests shifting capital into tax-free buckets, like Roth accounts, to settle your tax bill at today's known rates. You're effectively ousting that silent partner forever.
Lynn Alden adds to this defensive posture with her debasement math. She points out that the total currency supply grows at an average of 7 to 8% annually.
Yeah, it's relentless.
If your overall portfolio isn't beating that, the system is fundamentally shorting your purchasing power. You have to short the currency by holding scarce assets. But looking at the sources, there is a massive structural disagreement among the experts on how to actually hold scarce assets.
Oh, definitely. The tension between digital and physical scarcity is peaking. Tom Lee argues for Bitcoin, which is currently at $73,446. But he isn't arguing for it merely as digital gold protecting against debasement.
Wait, really? What's his angle?
His thesis is deeply tied to the AI compute shock. Those autonomous AI agents we just talked about. They will require the Bitcoin Lightning Network for fractional penny microsettlements that traditional banking rails simply cannot process.
Oh, so it's a utility play for AI.
Exactly.
But Andy Schectman completely rejects the digital side of that equation. He argues that only physical metals, specifically delivered and removed from the ComEx, allow a true escape from paper liabilities.
Right.
For him, the structural debasement thesis means you need something you can physically hold, completely untouched by the banking system or the power grid.
It's the distinct difference between investing for AI transaction utility versus true systemic escape. Finally, we should mention a defensive tactic for your traditional equity holdings.
Yeah, what's the play there?
If you have a large portfolio and you're worried about Ryan Bohl's 70% probability of a Strait of Hormuz resumption fail, you don't actually have to liquidate your core tech stocks.
That's good.
You can buy a put option on the S&P 500, essentially shorting it just 3% down from its current all-time high. This acts as catastrophe insurance against a global energy rationing event. It caps your downside while keeping you exposed to the upside.
That's a smart mechanical hedge. And while you're managing that, keep a very close eye on the bid-to-cover ratio on 2-year Treasury auctions.
Very important.
This is simply the ratio of how many investors want to buy government debt versus how much the government is actually trying to sell.
Yeah.
It recently dropped to 2.44. If that number keeps falling, it shows weak demand, meaning the government is struggling to find buyers for its own debt, which signals a severe domestic liquidity drain. As always, this is analysis, not advice. Talk to a qualified professional before making changes to your portfolio.
Absolutely.
So, to recap our watch points for the week, monitor the 50% physical shipping capacity in the Strait of Hormuz. Audit your 401k for the silent partner risk driven by future tax rates. Track the $100 billion a month defense stimulus against the S&P 500. And watch those base chain metrics for the agentic AI compute shock.
Yeah, and I'll leave you with this final thought to ponder as you look at your own allocations this week. If the Islamabad negotiation gap leads to a reclosing of the Strait of Hormuz by April 25th, which structural force will prove stronger? The physical shortage cliff that threatens global energy rationing, or the $100 billion a month wartime stimulus that Tom Lee believes will carry the S&P 500 to 7,700?